All right, so investing in mutual funds on the basis of past return is actually not a great idea. But then this actually holds true if you're investing in sectoral or thematic funds. Now, sector and thematic funds tend to be cyclical in nature, and the performance depends totally on the host of factors, which also includes your news development, economic conditions, global trend. Government policies and obviously market sentiments. Now, talking about the current market sentiments and the kind of momentum that's in the market, what exactly is the sector or the theme that you should be looking into for having stellar returns? A lot of sectors have seen a huge run up, and we're talking about run up right from elections, then post-election, pre-budget, post-budget. What kind of momentum currently is building for what kind of sectors? And given the fact that few sectors have already shown a great run up. Is there any scope or any legroom left for any more momentum or any more profit that you can see in your investment? Let's discuss all of this. I have on board with me today Nirav Karkera, Head of Research, Fisdom. Nirav, good evening and welcome to the show. Let's begin with these sectors where we've already seen a good amount of run up, and there is very little or no scope or any legroom left for any more profit that investors can have on their investments. Nirav.
Yeah, so there's something that you showed right at the outset, a table that basically highlighted the run up across various sectors, and I feel this probably speaks volumes about where do we stand today in terms of sectors performing in isolation versus the benchmark. What we are seeing today is a broad-based rally. Most of this rally has been pretty well captured across several sectors. At this point in time, to have a sectoral play is a very nuanced approach that one must take. It is not going to be as simple as simply riding a cycle, especially when the broader markets are already at slightly elevated levels or touching record highs very frequently. So at this point in time, touching cyclical or thematic plays could be a very cautious play, and it would be advisable for investors to seek out professional guidance or rely on very thorough research on specific sectors if they are trying to play any cycles of sorts, because at least the valuation cycle is not as much playing in favor of thematic bets at this point for most themes at least.
All right, so now let's go sector specific. Let's have a sector specific conversation on this and the kind of information that you've created in your report, Nirav. What's the kind of sector that you are betting on? We will also go on. We'll also have a discussion on the kind of thematic funds or sector funds that investors can bank on or bet on. But so far, let's talk about the top hot sectors or themes.
Absolutely. So, whatever, we spoke about just a couple of minutes ago, the truth of the matter is that investors are now much more savvier and are willing to allocate towards sectors, right? And that's evident in terms of flows also. I feel 3 years, 2 years back, it was around, the flow into the sectoral slash thematic bracket was around 20 odd thousand crore, which moved up the next year to 30 odd thousand crore. And this year, YTD, we are almost at around 90,000 odd crore, which is 3x of the previous year, right? So there is a clear appetite. And now, when there's such an appetite and intent to allocate, the right way to do this is to look at up and coming sectors who offer you a valuation edge, at least at a relative from a relative standpoint, and also a margin of safety. So some of the sectors that we like, number one, I would say IT and technology is looking really good right now. Although there has been a broad-based rally across several facets of the market, IT and technology has not really, run up as much as it would have. And of course, this is majorly attributable to the global overhang. But as the demand situation is improving all around the world, and as the recessionary fears are abating, the deal pipeline for IT companies is strengthening, and I'm speaking especially in favor of large cap oriented, large mid cap oriented IT and technology funds that are pretty well positioned to capture on the upcycle. So there are various factors like increasing demand from global clientele, a stronger domestic demand environment, the rise of AI and ML, and India's ability to cater to such transformation projects, right, digitization and transformation projects, it'll work well for IT as a sector. So there are a couple of funds that capture the upside here for this segment. The ones that we particularly like are ICICI Prudential's technology fund and SBI's technology fund. These funds seem to be pretty well positioned at this point in time. Probably the next key sector that or theme rather, this is slightly broader also, would be manufacturing and public sector enterprises. Of course. So whenever we talk about public sector enterprises, the entire narrative seems to linger a whole lot onto divestment plans. But even apart from that, if you look at uh, several public sector enterprises, the balance sheets are looking much healthier than before. The manufacturing sector has gained prominence. It's not a new theme. It has been around since some time now. But one thing that we are seeing is that most of the agenda items that were spoken about a couple of years back is now actually falling into place and being executed, and the accruals on those accounts are kicking into the financials, right? So we are seeing it materialize, which brings in a whole lot more promise to the segment. Within the segment, probably in manufacturing, we really like the way ICICI Prudential is, managing its manufacturing fund. At the same time, in terms of PSU equity, we like the way Aditya Birla Sun Life PSU equity is doing, and Invesco India PSU is also doing PSU equities. So this is manufacturing and PSU. And one third theme, we cannot complete this conversation around up and coming themes till we talk about infra, right? So in infra as a theme, and when I talk about infra, I am also including energy as a part of infra. So infra and energy as a theme has a long way to go. In fact, within infra specifically, double clicking on energy, we believe there's a huge, a huge potential in terms of growth runway for energy companies within India. And of course, the macros are all in favor. With the peak power deficit situation continues to persist, and with rising demand, not just, and when I'm talking about rising demand, I'm not just talking about the residential, but the rising commercial and infrastructural demand of power generation and power transmission as services is on the rise, and on the rise in a very sustainable manner. India has committed and is clearly on the path of accelerating the energy transition program. So there are several plays that will help you capture the
Right.
opportunity in
So
terms of spend.
having said that, Nirav, now these themes and these exposures one will also find in their large cap funds. A lot of this exposure actually. Now, having said that, if one wants to have a pure sector or a thematic play, what's the time horizon we are looking at, and also the risk involved? Because a few of these sectors and themes are also driven by international sentiments or global market sentiments. So, how can one navigate through all of that?
Right. So right at the outset, these are highly cyclical bets. Okay, and while like with any other equity play, the holding horizon should be really long. But I feel for sectoral plays, it should be much more longer than more flexible funds like flexi caps and multi caps. In fact, as a thumb rule, and this is just as a starting point, probably have 7 to 10 years in mind whenever you are trying to play out a cycle, because cycles could tend to be highly volatile, but as long as it is on an upward growing trajectory, you get to capture the entire upcycle. So that is one. You've also got to be cautious about the allocation into such segments. And also when we talk about thematic cyclical plays, there's of course dependency to external vectors also, but that becomes a part and parcel of the risk that we spoke about. Like for instance, when you look at pharma funds 4 years back, at the cusp of the pandemic, it in calendar year 20, it returned almost 70 odd percent returns, the category, right, mutual fund category, and these are ballpark figures. The year after, it delivered around 20 odd percent year end. So, those who were thrilled by looking at past performance and entered towards the end of the calendar year 20 were in for a slight disappointment when they saw in a 20% gain, but they were still okay until they moved into the next year where there was a negative 10% on an average delivered by the category. And now by the time most people have exited this entire cycle, the last calendar year, we are once again up by almost 40%. So this is an example of how
Exactly.
it.
Sure. But over here, one also really needs to have, Nirav, the right kind of expectation as far as return is concerned. Talking about Nippon India Power and Infra Fund, 56%, HDFC Infrastructure, 53. We've seen funds really, these kind of funds giving up returns up to 60%. But having said that, because these themes are cyclical in nature, it's very important that you have a return expectation setting done in your portfolio as well. Not necessarily the kind of returns that you've seen in a particular calendar year, it might get repeated. And that's the time when it is not repeated, that's the time when investor actually loses confidence and is worried about the specific allocation. How do you navigate through this now?
So return expectations must be moderated at the very outset. I'd say, anyone looking at any sort of returns for the past 5 years in any thematic or cyclical play must understand that going forward, it may be very difficult for such returns to replicate. So you will have to moderate it and moderate it significantly. One thing you need to understand characteristically, returns in cyclical plays like thematic and sectoral funds are going to be lumpy. There are going to be really good years, and then there are going to be really bad years. The entire premise is over a longer period, the bad years offset some of the good year returns, and on an average, you will make slightly more than more diversified funds simply because you have a more concentrated portfolio right now. So this is also assuming you're playing the right kind of theme, right? If you're caught on the wrong side, you can also severely underperform. So the right way to look at returns from thematic and sectoral funds is first moderated significantly from what you've seen in the past 5 years, and second, don't place a whole lot more premium over what you would otherwise generally expect from a diversified equity funds. Just have a little headroom, at least in terms of CAGR. Anywhere probably in terms of 100 to 200 odd bips as a spread over whatever your expectation or realistic expectation should ideally be from flexi-cap funds, for example.
All right, Nirav, that will be all. Thank you so much for taking time out and explaining our viewers every aspect of having a sectoral or thematic exposure in their portfolio. Thank you so much. Time for a quick break.